The silver market is flashing warning signs we haven't seen on Wall Street in decades. Quietly, behind the scenes, immense pressure is building inside the COMEX system, the very backbone of global silver trading. Analysts are now asking a question that would have sounded insane just a year ago. Is COMEX heading toward a default? And could silver explode to $200 per ounce or collapse entirely? This isn't speculation driven by social media hype. This is about structure, supply, leverage, and a system that might be stretched beyond its breaking point. To understand why this moment is different, we need to start with one uncomfortable truth. Most of the silver traded today doesn't physically exist. The COMEX futures market trades hundreds of ounces of paper silver for every single ounce that can actually be delivered. This imbalance has always been there, but now something has changed. Demand for real, physical metal is colliding with a rapidly shrinking supply. Over the last few months, industrial demand for silver has surged. Think about it. Electric vehicles, solar panels, military technology, and even AI infrastructure all rely heavily on silver. At the same time, mine supply has completely failed to keep up. New discoveries are rare, production costs are soaring, and major mining regions are facing serious political and environmental restrictions. The result? A physical market that is tightening incredibly fast. Meanwhile, COMEX continues to operate on leverage, and this is where the real danger begins. When investors buy silver futures, they assume they can take delivery of the physical metal if they ask for it. But what happens if too many people demand physical silver at the same time? The simple answer is, COMEX doesn't have enough metal to meet mass delivery requests. The system survives on cash settlements, rollovers, and most importantly, confidence. As long as traders trust the system, it works. But once that trust cracks, everything changes, and right now, trust is cracking. In recent weeks, the premiums on physical silver in the United States have skyrocketed. Coin dealers are reporting shortages. Delivery times are getting longer and longer. Large buyers are paying way above the spot price just to secure metal now instead of later. This is a critical signal. When physical premiums rise, while futures prices lag behind, it means the paper market is losing control. Some institutional players already see the risk. According to market insiders, certain hedge funds and even sovereign buyers are quietly shifting their positions from paper contracts to allocated physical silver. This isn't a bullish retail frenzy. It's a defensive move by players who understand systemic risk. When the smart money stops trusting paper promises, the countdown begins. So where does $200 silver come into the picture? If COMEX faces a delivery crisis, even a partial one, panic could erupt. Traders holding short positions would scramble to cover them. Physical buyers would rush in. The paper-to-physical ratio would collapse. In that scenario, silver wouldn't rise slowly, it would gap higher violently. History shows us that when commodities break free from artificial pricing structures, prices can overshoot dramatically. A move to $150, $180, even $200 wouldn't require years. It could happen in a matter of weeks. But there's another, darker outcome. One Wall Street fears even more, a total collapse. If COMEX responds to a delivery crisis by forcing cash settlements, changing the rules mid-game, or halting trading altogether, confidence in paper silver could evaporate overnight. Futures contracts and ETFs could crash, while physical silver becomes completely untouchable. The prices you see on screens might fall, even as real metal disappears from the market entirely. This would create a bizarre two-tier system, paper silver collapsing in value, while physical silver becomes priceless and unavailable. Retail investors caught on the wrong side of this, those who are over-leveraged, paper-only, or chasing the momentum too late, could be completely wiped out. This is exactly why the current moment is so dangerous. The silver market is standing between two extremes, explosive upside or systemic failure. There is almost no middle ground left, and macroeconomic pressure is adding fuel to the fire. US debt levels are soaring, interest rates remain unstable. Global confidence in fiat currencies is weakening. In every major financial crisis throughout history, hard assets eventually reprice higher, but not before volatility destroys unprepared investors. Silver is especially volatile because it sits at the intersection of money and industry. When fear rises, investors buy it for protection. When growth accelerates, manufacturers need it for production. That double demand makes silver uniquely powerful and uniquely dangerous during times of systemic stress. Right now, both of those forces are active. So what should you be watching? First, the COMEX delivery reports. Any unusual delays or declining registered inventories are major red flags. Second, watch the physical premiums in the US market. Rising premiums mean real demand is overwhelming supply. Third, pay attention to any rule changes. Exchanges often rewrite the rules just before a major breakdown. And fourth, watch for volatility spikes. Sudden, irrational price moves often signal internal stress and panic. The biggest mistake investors make in moments like this is assuming it can't happen. History is filled with markets that failed because people believed the system was too big to break. COMEX is no exception. Whether silver reaches $200 or the paper market collapses first, one fact is undeniable. The silver market of the next few months will not look like the silver market of the past decade. This is not a normal cycle. This is a structural reckoning. Those who understand the mechanics of the market, not just the price, will be the ones who survive. Those who do not may learn the hard way that paper promises are worthless when reality shows up at the door. The silver market shock is no longer just a theory. It's unfolding in real time. And the next move could rewrite financial history. Thanks for watching. In part 1, we exposed why the silver market is under extreme pressure. But today, we're diving into something even more critical. How a COMEX breakdown could actually unfold in real time, and why most investors won't see it coming until it's far too late. Markets don't just collapse with a single dramatic headline. They break quietly through a series of small, technical failures that most people simply ignore. And right now, the silver market is following that exact script. The core of the problem is leverage. For every single ounce of physical silver sitting in a COMEX vault, there are dozens, maybe even hundreds of paper claims tied to it. We're talking futures contracts, options, ETFs, swaps, and unallocated accounts, all referencing the very same limited pool of metal. This system only works because of one simple assumption, that most people will never ask for their physical silver, they'll just trade the paper. But something has fundamentally changed. Over the past year, large, powerful players have started treating silver not as a trade, but as a strategic inventory. Governments, defense contractors, and major industrial buyers are now viewing silver as a critical supply chain asset, not just a speculative commodity. This shift alone puts massive, unprecedented stress on a system designed for financial trading, not for real-world shortages. So here's where the chain reaction begins. When a trader stands for delivery on COMEX, meaning they want the physical metal, the exchange has several tools to prevent a panic. It can encourage a cash settlement instead. It can try to roll contracts forward to a future date. It can offer financial incentives for traders not to take the metal. Most of the time, this works just fine. But what happens if too many delivery requests hit at once? Then the system faces a math problem it simply cannot solve. You see, COMEX doesn't actually own the silver, it only manages the claims on it. If even a small percentage of contract holders suddenly demand their metal, the vault inventories would be drained almost instantly. At that point, the exchange is forced to make a choice. Honor the contracts and let the vaults run empty or preserve the system itself. And historically, exchanges always choose to protect the system. This is where rule changes come into play, and it's one of the most dangerous signs investors need to watch for. Think about sudden, overnight increases in margin requirements, or position limits that are changed without any warning, or settlement terms being clarified in the middle of a crisis. These aren't neutral procedural decisions. They are emergency brakes designed to stop the bleeding. We've seen this movie before. During past commodity squeezes in other markets, exchanges have stepped in to shut down price discovery. They didn't announce a failure. They just quietly changed the rules of the game. The people holding paper positions got trapped, forced to sell at artificial prices, while those holding the actual physical commodity walked away completely untouched. Silver is uniquely vulnerable because it plays a dual role. It is both a monetary metal, a store of value, and a critical industrial input that we cannot live without. This dual role creates a fierce competition between financial traders and real-world users. And when those industrial buyers step in aggressively because they have to, financial pricing models start to break down. And guess what? That is happening right now. U.S. manufacturers are reporting longer and longer lead times for essential silver components. Demand from the defense sector is quietly rising. And the push for renewable energy, with solar panels needing massive amounts of silver, continues to expand globally. None of this demand is optional. A factory can't just substitute silver for another metal without redesigning entire production systems, which can take years and cost millions. At the same time, global mine supply has been stagnant for years. This is creating a slow-motion squeeze that doesn't always show up on the daily price charts, until suddenly it does. Here's the key insight that most investors completely miss. COMEX can survive high prices. Silver at $50, $80, even $100 an ounce. The system can handle that. What it absolutely cannot survive is a loss of confidence. If traders begin to believe that delivery of the physical metal is no longer guaranteed, the entire futures market loses its purpose. Why would you buy a contract for something you can't actually get? At that point, liquidity evaporates. The spreads between buy and sell prices widen dramatically. Volatility explodes. Price no longer reflects simple supply and demand. It reflects pure, unadulterated fear. This is how silver could surge violently toward $150, $180, or even $200 per ounce. Not because of retail speculation, but because the very mechanism we use to price it breaks down. But here's the dangerous flip side. The same mechanics that could cause a price explosion can also cause a paper market collapse. If the exchange is forced to declare force majeure, and cash settle all contracts during a delivery crisis. The price of paper silver could crash almost instantly. ETFs that track these futures prices would follow suit. Retail investors, staring at their charts, who would see prices plummeting and panic sell, not realizing that, at the same time, physical silver has become impossible to buy at any price. This contradiction isn't just a theory, it is exactly what happens when financial claims become detached from physical reality. This is why the smart money is already acting, quietly and early. Institutional investors aren't shouting about it on social media. They are methodically converting their exposure from unallocated paper accounts to allocated, physically backed holdings. They are securing metal completely outside the exchange system. They are laser focused on reducing their counterparty risk. Meanwhile, many retail investors are being lured into high leverage positions and risky short-term trades, the very places where the risk is highest. Psychology plays a brutal role here. When silver finally spikes, latecomers will rush in emotionally, buying at the top. When the exchange inevitably intervenes and the paper price drops suddenly, that same fear will force them to sell at the absolute worst possible moment. The winners in this market won't be the loudest, they'll be the calmest and the most prepared. Another red flag that few people are discussing is geopolitical risk. The silver supply chain is fragile, crossing multiple sensitive regions around the globe. Any disruption, new trade restrictions, sanctions, or a country deciding to put export controls on its own silver could instantly tighten availability. If a major silver-producing nation decides to limit its exports to protect its own industry, the impact on COMEX inventories would be immediate and severe. This is why some analysts believe the real trigger for this crisis wouldn't be financial at all. It will be political. The market is already so fragile that it wouldn't take much to push it over the edge. So, what does all this mean for the coming weeks and months? It means we are entering a phase where small news can cause massive price moves. It means volatility is about to become the new normal. And it means that traditional indicators and chart patterns are going to stop working. Because the underlying structure of the market is what's at risk. The game is no longer about reading charts. It's about understanding the system's plumbing. Those who understand how COMEX really works will recognize the warning signs early on. Everyone else will be reacting after the damage is already done. In part 3, we'll go even deeper. We'll explore exactly how institutions are positioning themselves, what specific signals will confirm that a breakdown is imminent, and what you can do to avoid being trapped on the wrong side of a truly historic market event. Because when this finally breaks, it won't come with a warning headline. Welcome back to our series. If part 2 explained how the COMEX system could break, part 3 answers the most dangerous question of all: what are institutions doing right now, and what happens when they're done positioning? Because by the time the public finally notices, the opportunity phase is already long gone. Markets always move in distinct stages. First, the insiders make their move. Then, the institutions follow. After that, the headlines appear. And finally, the crowd rushes in. The silver market is currently trapped between stage 2 and stage 3. And this is the most volatile and unforgiving zone you can be in. The evidence is everywhere you look, if you know where to look. Institutional investors are no longer treating silver as a simple trade. They are treating it as insurance against a total system failure. That fundamental shift in mindset changes everything. Let's start with the futures market. The volume patterns are changing. Open interest is no longer growing with the price the way it used to. Instead, what we're seeing is position consolidation. This is a clear sign that large players are reducing their exposure to paper contracts while still maintaining their directional bias. This is absolutely critical to understand. When institutions expect stability, they pile on leverage. But when they expect chaos, they do everything they can to reduce counterparty risk. Right now, counterparty risk is the keyword. Large funds understand something that many retail investors don't. COMEX isn't just a market, it's a confidence machine. Once that confidence cracks, the price becomes irrelevant. The structure itself takes over. That's why we're seeing a quiet but aggressive move toward allocated physical silver, off-exchange storage, and private vaulting. These moves don't show up on flashy YouTube thumbnails, but they show up later in explosive price movements. Another confirmation signal is happening in the world of ETFs. Some silver ETFs are experiencing unusual inventory changes that simply don't match the retail inflows. Metal is moving, but not always in the direction investors expect. This suggests a massive reallocation is underway, not just simple accumulation. Institutions are positioning themselves for a major divergence between the price of paper silver and the price of physical silver. That divergence is the real danger. When price discovery breaks, the market splits in two. You have the price of what silver is trading at on a screen, and then you have what silver is actually worth in your hand. Historically, that moment is when markets either reset violently higher or they collapse entirely. There is no soft landing. Another signal most people miss is the activity in the options market. Deep, out-of-the-money call options are being accumulated quietly, while short-dated speculative positions are declining. This tells us that institutions are preparing for a tail risk event, not a smooth, predictable trend. They're betting on something big without committing capital in ways that would expose them to sudden rule changes, because those rule changes are coming. Every single time a commodity market approaches a structural failure, the exchanges respond in the exact same way. Margin requirements are hiked overnight. Trading is halted. Position limits are changed. And finally, forced cash settlements are imposed. These measures are never announced in advance. They appear suddenly, but only after the insiders are already safely positioned. Retail traders who rely on leverage are always the victims. Now let's talk about the point of no return. There's a specific moment in every commodity crisis where a reversal becomes impossible. In the case of silver, that moment is not a price level, it's a delivery event. If a large participant, a whale, refuses a cash settlement and insists on taking physical delivery during a period of tight inventory, the entire system will be tested. And even if COMEX survives that initial test, the confidence in the system may not. Markets don't actually need a complete failure to collapse. They only need doubt. Once doubt begins to spread, liquidity vanishes. The bid-ask spreads widen to insane levels, volatility spikes, and huge price gaps replace what used to be smooth trends. At that point, all traditional analysis, all the charts and indicators you've been taught to rely on, stop working. This is the environment where $200 silver becomes possible, not because of hype, but because the price is no longer anchored to anything real. But there is a darker outcome. If the exchanges successfully suppress the price through forced settlements, paper silver could actually implode. The futures prices you see on the screen could fall, while the premiums for physical silver explode to unheard of levels. ETFs could completely decouple from the metal they're supposed to track. Investors watching the charts would be completely misled into thinking the crisis is over right before it fully arrives. That scenario destroys wealth silently and efficiently. This is why timing matters far more than prediction. The silver market right now is not asking you what you believe. It's asking you how prepared you are. Prepared investors are doing three things right now. They are reducing their leverage, they are reducing their paper exposure, and they are increasing their control over their physical assets. Unprepared investors are just chasing volatility, hoping to catch a lucky break. There's one more confirmation signal, and it's a psychological one. The media coverage of silver is shifting in tone. Instead of simply dismissing it, major outlets are beginning to frame silver as unstable, dangerous, or too volatile for the average person. This is classic language that appears right before major repricing events. It's a signal that institutions want to create distance from the popular narrative. When the media starts warning late investors to stay away, it's because the insiders are already positioned. Always. So what happens next? The silver market is rapidly approaching a binary event window. There are only two paths forward. Either price discovery breaks upward in a spectacular fashion, or confidence collapses downward, taking the paper market with it. Both paths involve chaos. Both paths will punish anyone using leverage, and both paths will reward preparation. There will be no announcement, there will be no countdown, there will be no warning bell. When it happens, it will feel sudden, but it won't be random. The signs are already here for those who are willing to see them. In part 4, we'll break down the exact triggers that will confirm the breakdown has begun, what you should do in the first 24 to 72 hours, and how past commodity crises can tell us what comes next. Because once this switch is flipped, there is no going back. We've talked about how big institutions are getting ready, but now we're diving into the one question everyone asks. What exactly triggers the break in the silver market? And more importantly, what happens in the first 24, 48, and 72 hours after it all starts? History teaches us a critical lesson. The biggest fortunes aren't made slowly in bull markets. They are made, or completely wiped out, in the first few hours of a structural failure. And believe me, the silver market is a lot closer to that moment than most people even begin to realize. First, let's get one thing straight. The big event, the trigger, it won't be announced with a giant headline that says COMEX default confirmed. It never works like that. Instead, the trigger arrives silently. It's often buried deep within routine market data or cleverly disguised as a temporary adjustment. There are 4 realistic trigger events, and we only need one of them to happen for the entire system to unravel. Trigger number 1 is a large demand for physical delivery during a very tight window. Imagine a major player decides to stand for delivery, demanding their physical silver at a time when the registered inventories are already stretched thin. COMEX will have to scramble. You won't hear the word default on the news. Instead, you'll hear phrases like logistical delays, settlement flexibility, or market stability measures. But make no mistake, that language is a code word for extreme stress. Trigger number 2 is an emergency margin hike. This is a subtle but powerful signal. When COMEX suddenly and drastically raises the margin requirements to hold a futures contract, especially when the price isn't even moving much, it shows there is deep-seated fear inside the system. This forces traders who are using leverage to sell their positions immediately. This creates an artificial price drop, which conveniently hides the much deeper problems that are brewing just beneath the surface. Trigger number 3 is forced cash settlement. This is what you could call the nuclear option. If the exchange suddenly announces that contracts will be settled in cash instead of with physical metal, that's the end of the game. Confidence doesn't just erode, it shatters instantly. At that moment, paper silver is exposed for what it is, just a promise, not a real tangible asset. The trust that holds the entire paper market together simply evaporates. And finally, trigger number 4 is changing the rules in the middle of the game. If position limits, delivery rules, or settlement terms are suddenly altered without any warning, it means the exchange is no longer protecting the market. It's protecting itself. Any one of these 4 events can flip the switch. And once that switch is flipped, the clock starts ticking. So let's look at the first 24 hours. The period from hour 0 to 24 is all about confusion, a fake sense of calm and dangerous traps. Right after a trigger event, the price of silver might not explode higher. In fact, it could even fall. Why? Because the system will do everything in its power to look normal. Trading algorithms will be deployed to suppress volatility. The financial media will stay completely silent. Market analysts will go on TV and call it a healthy correction. And this is where the trap is set. Retail traders will see the price drop and either relax, thinking the danger has passed, or worse, they'll see it as a buying opportunity and add even more leverage to their positions. But behind the scenes, something far more sinister is happening. Liquidity is vanishing. The gap between the bid and ask prices widens dramatically. The premiums you pay for physical silver coins and bars start to rise, but they do so silently, while the paper futures price on your screen stays capped or even goes down. This is the moment when the smart money does absolutely nothing publicly. They're not buying, they're not selling. They already got into position weeks or even months earlier. It's the retail money that is unknowingly walking straight into the fire. Now we move into the next phase, from hour 24 to 48. This is when the divergence begins. The split between the paper market and the physical market becomes obvious for anyone who's paying attention. They start telling 2 completely different stories. The futures price on the COMEX becomes erratic and unstable. The big silver ETFs, like SLV, start to lag behind or completely decouple from the price of the metal they're supposed to track. And physical silver, it starts disappearing from the websites of online dealers. Premiums don't just rise, they explode overnight. At the same time, social media will start buzzing with conflicting narratives. You'll see one group of people screaming, "Silver is crashing," while another group is shouting, "Silver is breaking out." And strangely, both of them will appear to be right, depending on which market you're looking at, the paper market or the physical one. This is the most psychologically dangerous phase. It's designed to create panic and confusion. Traders start making emotional decisions. Investors freeze, unsure of what to do. The volatility becomes violent and completely irrational. And the margin calls on leveraged positions start a domino effect, accelerating the damage. By the time we reach the 48 to 72 hour mark, we've hit the point of no return. The illusion is over and reality wins. One of 2 things will happen. Either the price of silver breaks upward so violently that it shocks the world, or the paper silver market completely collapses while physical metal becomes untouchable at any official price. At this point, the exchanges may halt trading altogether, the rules will change again, liquidity might vanish completely. Your charts, your technical analysis, all of it becomes useless. The only thing that matters is access. Do you have access to real physical metal? This is where a $200 silver price becomes a real possibility, not as some far-off price target, but as a sudden repricing event that happens over a few days. And if the collapse scenario plays out, wealth is destroyed, but it's destroyed quietly. The ETFs go down, the futures contracts are liquidated for cash, maybe for pennies on the dollar, trading accounts are wiped out. And all the while, physical silver is trading hands off screen in private sales at massive unrecorded premiums, two separate markets leading to two drastically different outcomes. And the only thing separating them is the one mistake of trusting the paper system during a crisis. So why do most people lose in this scenario? It's not because they were wrong about the direction of the price. Many people correctly believe silver is undervalued. They lose because they trusted the system to function normally during a period of extreme stress. They made three fatal assumptions. They assumed there would always be fair settlement, they assumed there would always be continuous liquidity, and they assumed pricing would always be rational. All of those assumptions fail during a structural break. Silver isn't just a volatile asset. In moments like this, its behavior becomes binary. It's either working or it has completely failed. Experienced investors do things very differently. They don't chase the price on the screen. They don't panic when volatility spikes. And they certainly don't wait for confirmation headlines on the evening news, because by then it's far too late. Instead, they watch the signals that matter, the delivery data from the COMEX, the sudden rule changes, the behavior of physical premiums, and the signs of liquidity stress. They understand one brutal truth. When your access to the physical asset disappears, the official price becomes completely irrelevant. The final reality is this: the silver market is rapidly approaching a moment where the outcomes are compressed into a few days, not years. Once that trigger is pulled, late reactions are punished severely. Using leverage becomes lethal, and the appearance of calm is just an illusion designed to trap the unprepared. Whether silver explodes to $200 an ounce or the paper markets collapse first, the damage happens fast and it happens without mercy. This isn't just a prediction. This is a pattern. This is how every structurally stressed commodity market in history has behaved. The only question left is, will you be prepared when it happens? Thanks for tuning in. Remember to think critically and do your own research. If you found this valuable, hit that subscribe button for more insights. Stay safe out there. We've spent this entire series exploring the mechanics of a silver market breakdown. We've looked at the triggers, the initial chaos, and the fallout. But all of that leads to the one question that truly matters. What should you do right now before everything breaks? Because once the trigger is pulled, there are no second chances. There will only be two groups of people: those who prepared and those who reacted too late. And as history has shown time and again, it is ruthless to that second group. Welcome to what I call the final positioning phase. Every major market crisis, from 2008 to the dot-com bust, has a quiet period right before the explosion. Prices seem to move sideways. Volatility feels under control. The financial news cycle is, frankly, boring. It's the phase where most people lose interest and look away. But this is exactly where we are right now. Institutions and the so-called smart money have a different name for this period: the positioning window. This is when they quietly finish setting up their exposure and then they wait. Notice, they aren't chasing prices higher. They aren't trying to predict the next headline. They are systematically removing risk, not just from their portfolios, but from the system itself. This is the most critical shift happening in the silver market today. It's not about bullishness or fear. It's about a fundamental withdrawal of trust. The big players are no longer asking, will silver go up? They're asking a much more profound question. What happens if the entire system fails? And that question changes everything. The single most dangerous mistake any investor can make right now is assuming they'll have time to react. I hear it all the time. I'll buy silver if it breaks out to a new high. Or I'll get out if it starts to crash. I'll just wait for confirmation. This kind of thinking is perfectly fine in normal functioning markets. But it is a catastrophic failure during structural events, during the kind of breakdown we've been discussing. Why? Because when a major exchange like the COMEX begins to fracture, the rules of the game change instantly. Liquidity, the ability to buy or sell easily, vanishes. Trading halts are triggered, freezing the market. Settlement rules are changed on the fly. Your access to the market can disappear long before the price even makes its big move. By the time you get your confirmation, the window to position yourself has slammed shut. This is precisely why preparation will always beat prediction. So, what is the smart money doing right now, quietly, behind the scenes? They're not going all in on silver. They're not betting the farm. They are doing something far more sophisticated and powerful. They are limiting their downside to what we can call zero system risk scenarios. What does that mean in practical terms? They are reducing their exposure to leveraged futures contracts. They are avoiding short-term options that can expire worthless. Critically, they are shifting away from unallocated paper-based silver claims and securing physical assets they can control directly without a counterparty. Notice what's missing from that strategy. They are not chasing the upside. They are protecting their access. Because when a market truly fractures, access becomes the ultimate form of wealth. This brings us to the illusion of paper safety. Many investors believe that products like ETFs and futures contracts give them safety and flexibility. And in calm, orderly markets, that's largely true. But in a stressed market, that very flexibility becomes a trap. Every form of paper silver depends on a chain of promises. It depends on counterparties making good on their obligations, on clearinghouses functioning smoothly, on exchanges staying open, and on settlement promises being honored. Every single link in that chain becomes a potential point of failure during a system-wide breakdown. Physical silver, held in your possession, does not depend on anyone's permission to exist. That simple distinction becomes the only thing that matters when confidence finally collapses. Now we face the psychological test. The final positioning phase is boring, and that's precisely why most people will fail it. As human beings, we are wired for action. We want to act when our emotions are running high, when there's excitement and drama. But the most important and correct actions are often taken when emotions are low during the quiet times. Right now, the silver market is doing the most dangerous thing it possibly can. It is giving people time to get comfortable. Comfort creates complacency. Complacency leads to delay. And in this scenario, delay will inevitably lead to regret. When the trigger is finally hit, regret will be the most useless currency in the world. So how does this end? As I see it, there are only two realistic outcomes from here. Scenario 1, a violent repricing. In this outcome, the system holds together just long enough for price discovery to break free, but upwards. The massive short positions are forced to cover, scrambling for any physical silver they can find. Liquidity evaporates, and the price of silver doesn't just climb, it gaps higher in a matter of days, not months or years. $200 silver doesn't arrive as a slow, predictable trend. It arrives as an overnight reset. Scenario 2 is a paper collapse. In this version, the exchanges move to defend themselves above all else. They expand cash settlement, forcing contracts to be settled in dollars instead of metal. They accelerate rule changes to manage the crisis. The price on your screen, the futures price, might actually fall, creating the illusion of weakness. But in the real world, physical silver would completely disappear from the market. Dealers would have none to sell. The screen would show weakness, while reality would scream of scarcity. Most investors, glued to their charts, would never even realize what truly happened. Notice that both scenarios punish leverage and reward preparation, and both scenarios will likely arrive with shocking speed. There is one final warning signal that will tell you the positioning window has closed for good. It's when the mainstream media begins covering the silver story seriously. By the time you see headlines like "Silver volatility shocks global markets," or when investors rush into silver and it's already over, that kind of coverage only appears after the institutions have finished their positioning, never before. So for now, the silence is the signal. The one truth that matters above all else is this: silver does not need hype to explode. It needs stress. And the stress is already here. It's hidden from plain sight, buried deep inside inventory reports, delivery mechanics, leverage ratios, and the very fabric of institutional confidence. The surface of the market looks calm, but the underlying structure is not. This is how every major financial break in history begins. This is not about getting rich quick. This is about not being destroyed quietly. Markets can forgive bad timing. They do not forgive blind trust in systems that are showing clear signs of fracture. The silver market is sending its final warning, not through its price, but through its structure. Those who understand that critical difference will be prepared. Those who don't will be left staring at charts, confused, while reality moves on without them. This is the end of our series, but it is far from the end of the story. The next chapter will be written by the market itself, and it won't wait for anyone. Thank you for watching.